Hi, everyone. I'm Larry Moore, a tax partner at Baker Tilly. I provide tax services to tax exempt organizations and have been doing this now for 35 years. I'm here today with Karen Grease, who is going to give a talk about the Inflation Reduction Act. She's going to provide answers to some of the questions that we've been receiving from not for profit organizations around the Inflation Reduction Act and these sorts of things. Karen, I'll turn it over to you for an introduction.
Thanks, Larry. As Larry indicated, my name is Karen Grease. I'm a director here with Baker Tilly, and I too work in the tax area, working with not-for-profit or tax-exempt organizations. When I think of the Inflation Reduction Act, and Larry, I'll just speak for myself, is this reminds me a lot of what we've gone through 2, 3 years ago, as we're talking about the PPP loans, the employee retention credits that we had through COVID. Is the Inflation Reduction Act is actually additional opportunities for our not-for-profit organizations. So it's a really exciting time.
So, Karen, let's just jump right into it then. Our not for profit clients have really been asking a lot of questions as to how can they really benefit from the Inflation Reduction Act?
Right, right. What we're seeing is the incentives that we have are so significant in the sense that the greatest financial benefit is actually the tax credits that are available to our not-for-profits. They're now classified as direct pay, which results in a check for the credit amount being sent to our clients. There's no such thing as free money, but if you have certain projects that you're putting in place anyway within your organization, this is a way to really have those financial benefits from the tax credits. We also have an additional incentive under the Inflation Reduction Act that's available to us. It's the 179D deduction that's available to our nonprofits. But as a tax exempt organization, we don't benefit per se from the deduction. So this is actually monetized by assigning this deduction back to the designer of our energy project. And the designer does in turn provide a payment, and I often just refer to it as a purchase price reduction back to the organization. So both can be significant to our clients, but unfortunately, from a timing perspective, Larry, both the tax credit and the 179D deduction are benefits that will be available once the project is completed. So, as a tax exempt organization, you have to be able to finance the project throughout your construction progress. And this energy incentives that are available are merely part of the capital stack that you have as far as the overall project financing.
I know my clients like grants or free money. So tell us a little bit more about what does this direct pay really mean and how does it apply?
The direct pay itself, projects that generate energy. So if you have projects within your nonprofit organization that is truly that they're projecting the generation of energy, those are eligible for the tax credits under the IRA. So when we think in terms of solar projects, if it's rooftop or ground installations, wind, those generate energy, and those would be eligible for the tax credits. In addition to, we're seeing many of our clients, if you're installing electric vehicle charging stations or purchasing electric vehicles, you may benefit from the credits. There's also a residential housing credit that's out there that's available should you install or meet certain energy standards within your housing organizations, and this can be a multifamily housing. So we see opportunities within our housing organizations that are set up as tax exempts, or even our colleges, universities, perhaps within our dormitories, or replacing glass within your buildings with dynamic glass, wherever you are in the US, this is the glass that'll reflect the heat during the warmer months and absorb the heat into your building during the colder months. So all projects such as this could qualify for a form of the tax credit under the Inflation Reduction Act.
So I've talked to clients about that and they've come back and said, but Larry, we're not going to generate any electricity. So, but we are going to do projects where we are going to make our facilities more energy efficient? Are we left out in the cold, so to speak?
Fortunately, we're not left out in the cold, but as I'm talking to clients, that's what many times where we land with our conversations is clients are looking at, or not-for-profit organizations are looking at their energy efficiency and looking at energy efficiency improvements. So it could be replacing your HVAC, installing energy efficient lighting. Those are the projects that could generate the 179D deduction that I spoke of earlier. Again, the tax credits themselves are much more lucrative to tax exempt organizations. When we talk through the 179D deduction, your designer that you assign the deduction to may realize tax savings at approximately, say, 30%, federal and state effective rates, but they may only be willing to monetize at a lower rate. So if we have a $500,000 deduction that's assigned to our designer, their tax savings may be $150,000, but they're not going to monetize back to you at that dollar amount. It would be something less than that. Both are beneficial to the organization. As I said, the 179D isn't quite as financially lucrative.
So let's circle back to the credits then. How much credit can an organization get and how is it determined?
The credit itself, I'm going to say, is quite complicated, just like other aspects of the Inflation Reduction Act. Generally, and I'm speaking in broad terms, the base credit that's available is 6%. But then you meet the prevailing wage and apprenticeship requirements, or you have a small project that's generating less than 1 megawatt of power, then you have a 6 times multiplier that's applied to that, or excuse me, a 5 times multiplier that's applied to that 6% credit. So that will bring it up to 30%. So you're looking at a credit rate of 30%. You meet domestic content requirements, you could be eligible for additional credit of up to 10%. If you're located in an energy community, it could be an additional 10%. I know we've had many conversations, you have, Larry, as have I, talking about our environmental justice allocations for solar and wind. That could result in another 10 or 20% bump in that credit. So when we look at certain projects, we could be talking 40, 50, 60% of the qualifying property could, in essence, generate a tax credit. Now, many of the organizations that we talk to fund or are potentially funding the projects with tax exempt financing. And unfortunately, there's a 15% reduction, or I'll say a haircut, in place if our projects are financed through tax exempt financing. But again, what does that create for us? It creates an opportunity to really look at how we're planning to pay for the projects, and maybe we're paying for the qualifying property that generates the credit or the deduction outside of the tax exempt financing. So again, the takeaway is still all these rules are so very complicated, Larry.
So when do we have to get the project started or completed? What kind of window are we looking at for these projects?
Right. We're in that window now, is what I will say, is the energy incentives that are in place through the Inflation Reduction Act, which was signed into law in August of 22. Project must have been placed in service after December 31st of 22 to qualify for the incentives. So we have been talking to clients that placed in service projects before the end of 22, and those don't qualify for the incentives. So if you have current projects in place, we want to be talking about those projects that are ongoing to determine whether or not there are opportunities. The energy incentives are in place through 2032. So we do have time to react and really implement projects, but the timing is so very important. To realize the tax incentives, the credits or the 179D deduction, generally the projects have to meet the begun construction date of December 31st of 24 and be placed in service by December 31st of 28 to meet the incentives the way they read now or the way they stand now. If your construction begins after 12/31/24 or placed in service after 12/31 of 28, then these projects, I'm going to use the term generally, must be carbon neutral in order to qualify for the incentives. So as we tick away on the calendar, December 31st of 24 is only about a year and a half away. So we're now starting to unpack the implications of not meeting those critical dates. But organizations that have projects on their timeline, if it's deferred maintenance or construction, they are currently looking at the timeline and really planning so that they're meeting those dates.
So it sounds like there's a lot of facts and circumstances that this depends on, and it gets to be very complex once you get down into the details, but also very doable for not-for-profit organizations and potentially quite a bit of cash in pocket with respect to the direct pay component of the credits. So as we've gone through this and we've gone through a number of questions, Karen, do you have any final thoughts or words of wisdom for us?
Um, Now is the time to act for organizations to at least attempt to unpack or review the projects that are in place. We don't have all the rules yet as it relates to various aspects of the Inflation Reduction Act. Many of the credits have been around for years as it relates to our for-profit entities, but as a tax exempt, this is new. So we've received guidance on the prevailing wage and apprenticeship requirements. We received guidance in February speaking regarding the environmental justice aspect of the tax credits. However, we're still waiting on guidance regarding the mechanics of exactly how to apply for the refund or even other specific information. But now is still the time, Larry, that we should be walking through or working through our deferred maintenance or other capital projects within the timeline of your organization. Really, prioritizing those projects that could yield the greatest financial rewards. We've had clients, one that I'm thinking from northern Minnesota that could potentially yield a significant tax credit based on what's planned within their organization. But again, their project timeline is out well beyond the 2032 as far as implementing this energy project. So in the end, it's truly a cost benefit analysis or a cost benefit decision when deciding whether to proceed forward to capture these opportunities. So that would be my parting thought on the topic, is that it's complex, but now's the time to be looking at what you have within your organization.
Something definitely to think about now. Karen, thank you much for your information. We really appreciate it.
Thank you.